Just 25 days ago, Bitcoin hit an all-time high of $106,521. Today it's trading at $90,950, a 15% collapse that vaporized $300 billion from crypto markets. Think about that for a second. $300 billion gone in less than a month. But here's the glitch that doesn't make sense. While retail investors are getting obliterated, institutional money is still pouring in. BlackRock's Bitcoin ETF, called EBEAT, has accumulated over $60 billion in total inflows since launch. So if the smart money is buying, why is the price collapsing? The answer they won't tell you on CNBC isn't about demand. It's about forced liquidation, thin order books, and a mathematical death spiral that was engineered into the system from the start. Today, we're going to connect the dots. And by the end of this video, you'll understand why this crash was not random, it was inevitable. Let's rewind to October 10th, 2025. President Trump announced 100% tariffs on Chinese imports via social media post. Within hours, Bitcoin plunged from $122,000 to $104,000 and $18,000 free fall. This triggered the largest liquidation event in crypto history. $19.3 billion in leveraged positions wiped out in a single day. That's 19 times larger than the COVID crash, 12 times larger than the FTX collapse. Over 1.6 million traders were liquidated. 93% of them were long positions, meaning they were betting Bitcoin would go up. But here's where it gets sinister. Market makers, the firms that provide liquidity so you can buy and sell Bitcoin, suffered severe balance sheet holes. They pulled back. Order books thinned. And when the next wave of selling hit in November, there was no one left to catch the fall. Think of liquidity like water in a bathtub. When the drain is open and the faucet is off, the water doesn't just drain slowly, it accelerates as it swirls toward the bottom. That's what happened to Bitcoin. Thin liquidity turned a correction into a collapse. Trading volume surged 37% to $240 billion on November 21st, the peak of the panic. But here's the key. Volume on down days consistently exceeded volume on up days. That's not organic selling. That's forced liquidation algos and margin calls turning a bad day into a bloodbath. So if Bitcoin is crashing, why are institutions still buying? Here's the data that doesn't add up. In November alone, US Bitcoin ETFs saw 5 straight days of net outflows. BlackRock SIBI2, the largest Bitcoin ETF in the world, had a record single-day outflow of $523 million on November 18th. But zoom out. Since January 2024, spot Bitcoin ETFs have accumulated $58.2 billion in total net inflows. The average purchase price across all ETF buyers? $90,146. Bitcoin is currently trading at $90,950, meaning the average institutional buyer is barely in the green, and yet they're still holding. Why? Because institutions don't trade on sentiment, they trade on structural certainty. Regulatory clarity is here. The Genius Act passed in July 2025, creating the first federal framework for stablecoins. The Clarity Act, which would move most crypto oversight from the SEC to the CFTC, has bipartisan support and is expected to pass within 90 to 120 days. Meanwhile, venture capital poured $4.59 billion into crypto infrastructure in Q3 2025 alone. 60% of institutional investors plan to increase their crypto allocations in 2025. This isn't speculation. This is capital repositioning for a system they know is coming. But if the chart I'm about to show you is correct, retail investors are the ones funding this institutional accumulation. Let's talk about the forced liquidation machine. Bitcoin's crash wasn't driven by fundamentals, it was driven by leverage. In the months leading up to the October crash, open interest in Bitcoin perpetual futures, essentially leveraged bets, had exploded. When the tariff news hit, those positions didn't just lose value, they were forcibly closed by exchanges to prevent defaults. Here's the brutal math. Long-term holders, the so-called diamond hands, sold 26,000 BTC per day in November. That's double the July rate. One whale, Owen Gunden, a top 10 crypto holder, dumped his entire 11,000 BTC stack worth $1.3 billion between October 21st and November 20th. But where did that Bitcoin go? Into institutional wallets. According to CoinDesk research, most of the selling pressure in November occurred outside the ETFs. Translation: retail and whales are selling, institutions are buying. but they rebuying at lower prices because the liquidation cascade drives the price down before they step in. This is the wealth transfer they don't talk about on Bloomberg. Retail buys at $106,000 with leverage. Institutions buy at $90,000 with cash. Retail gets liquidated. Institutions accumulate. It's not a bug. It's the system working exactly as designed. But the chart I'm about to show you changes everything, because this crash wasn't just about leverage. It was about liquidity. Federal Reserve Chair Jerome Powell hinted in November that a December rate cut is not guaranteed. The probability of a cut dropped from 90% to 63%. That tightened liquidity across all risk assets, but Bitcoin, which reacts faster than equities to liquidity shifts, got hit first and hardest. Here's the mechanism. When the Fed keeps rates high, institutions pull capital out of speculative assets, like crypto, and rotate into safe haven assets like treasury bills. This creates a feedback loop. Liquidity dries up, which causes Bitcoin to fall, which triggers more liquidations, which causes more selling, which dries up liquidity even further. Brian Vietin, a research analyst at Siebert Financial, noted that Bitcoin has historically seen 5 corrections of 20 to 30% during bull markets. But this one is different. According to Deutsche Bank, crypto adoption has dropped to 15% of retail traders from 17%. That means fewer buyers are stepping in to absorb the selling. This is what they call the Tinkerbell effect. Bitcoin's value depends partly on belief-driven adoption. When sentiment turns, the price doesn't just fall, it accelerates downward because the narrative itself collapses. So let me zoom out and show you the big picture. Bitcoin is trading at $90,950. The key support level, the demand zone that institutions are watching, sits between $88,000 and $102,000. If Bitcoin breaks below $88,000, the next stop is $74,000, the 2024 all-time high. But if it holds, analysts are projecting a move to $180,000 to $250,000 by late 2025 or 2026. So here's the question. Are we watching a crash or a consolidation? Because while retail panics, institutions are positioning for the next leg up. Charles Hoskinson, founder of Cardano, predicts that within 6 to 12 months, 20 to 30 major countries will add Bitcoin to their sovereign wealth funds. That's hundreds of billions of dollars in buying pressure from price-insensitive buyers. This isn't speculation, it's geopolitical repositioning. But the average retail trader, they bought at $106,000 with 10x leverage. They got liquidated at $90,000. And by the time Bitcoin hits $200,000, they'll be sitting on the sidelines wondering what happened. So let me ask you this, are you watching the wealth transfer or are you part of it? Because the data tells a simple story. Retail sells at the bottom. Institutions buy at the bottom. And when the next rally comes, the people who panicked are the ones who lose. Bitcoin didn't crash because it's broken. It crashed because the system needed retail to sell so institutions could buy. The question is, do you understand the game, or are you just another liquidation on someone else's balance sheet?